My name is Kurt Zimmerman. Welcome, everyone. Thank you for joining the PAC meeting of the Community Foundation Broward this afternoon. I'm the chair of the PAC, and I'd like to welcome not only our PAC members, but the many guests who are in attendance today. Our meeting today is kind of the Super Bowl of PAC meetings insofar as we not only invite all the PAC members, but we invite special guests. So thank you, guests, for joining. Today, we have the privilege of having a panel of Bill Snyder, Marianela Collado, Adam Goldberg, and Jim Davis, and we're really looking forward to their presentation. I'll just give a few brief remarks on the front end, and then Mark will follow me, and then we'll jump in with Bill for the presentation. So I'd first like to introduce our newest PAC members, which are Philip Verdi of Truist Wealth, Andrew Jimenez of the Jimenez Law Offices, and Nella, one of our speakers today, Marianela Collado of Tobias Financial Management. So thank you, Philip, Andrew, and Nella for referring clients to the Community Foundation. And then I'd also like to thank, being that this is our last meeting of the year, I'd also like to thank those advisors who have referred clients who are in the process of discussing opening a fund with the Community Foundation. And those advisors are Adam Goldberg, another one of our panelists. Thank you, Adam. Christopher Weaver, David Ratcliffe, Mayor Dean Trantalis, Deborah Vogel, Emily Tracy, Greg Medali, Jeff Seltzer, Jim LeBate, Jill Ginsburg. Thank you, Jill, for being co-chair of the Joint Tax Committee, by the way. Kaylee Barbera, thank you, Kaylee, for being co-chair as well. Lisa Crawford, Nella, and Phil Verdi. So thank you all for introducing your clients to the Community Foundation. We appreciate that. By the way, the donations to the Community Foundation, when you look at them in total, about 80% of the donors originate through referrals, just like that. So this professional community is crucial to the success of the Community Foundation. So what are the benefits of being a PAC member? Well, it's an opportunity to stay connected with your peers. It's an opportunity to connect with fund holders at the various events that the Community Foundation puts on. It's an opportunity to stay connected to what's happening in the community and to attend the different events that are hosted throughout the year. And now that we're coming out of COVID, that we're going to, kick back into gear with in-person events. So I'm looking forward to that. It also gives you a chance to get a little peek into the thoughtfulness that goes into the grant making process, the respect for donor intent that is part of the culture of the Community Foundation. And it's an opportunity to partner not only with donors and the various nonprofits that are in the community. So it's a very enriching experience to be a member of the PAC. And then taking it to another level, when you are a donor or your client is a donor, you then learn about the expertise of the Community Foundation staff and the knowledge that they have about what's going on throughout Broward. You'll learn more about your community than you ever imagined, I would submit. It's an eye-opening experience. And also, you become part of an ecosystem of philanthropists, as opposed to being kind of a solo philanthropist on your own. You join in with others and pool funds to really make good things happen in Broward. So this is my last meeting as chair of the PAC. I believe it's been 3 years, and time flies when you're having fun. It's time to pass the baton to our next chair, who is Judy Bonnevak. So those of you who know Judy know what a great person she is, number one, and what a consummate professional she is. And she cares deeply about the Community Foundation and about Broward County in general. So we're very privileged to have Judy as our next chair. So with that, I would like to pass the podium to Mark Kotler. Mark?
Thanks, Kurt. And Kurt, I want to express how grateful we are for the last 3 years of leadership you've shown the PAC. I mean, the organization, or PAC itself, has grown. We're over 90 members currently. And you've been a great champion for philanthropy. We're so deeply indebted to you. And my first year and a half with the Community Foundation was lucky to coincide with your last year and a half of PAC leadership, and it's been a great experience. So thank you for all you've done. A little special recognition item is going to be sent to you. So when it arrives in the office, I hope it represents the true professionalism you've shown with us. I also want to welcome Judy. Judy Bonnevak has been the vice chair since January, And as Kurt mentioned, she's taking on the leadership as the PAC chair. She's a terrific woman, and she is a great professional and a colleague. So I look forward to the next years with Judy as our leader. I also want to share with you some really exciting news. This has been a banner year at the Community Foundation. We have 6 new community builders. So what is a community builder? It's a fund holder who has made $1 million plus endowed fund. And I'm going to announce 3 of those here today. Those 3 were all connected to the Community Foundation through a professional advisor. So we celebrate not only the community builder, but also the professional advisors who helped support the work that they're doing with the Community Foundation. Each one of these has diverse situations and philanthropic visions, so it brings some diversity and interest to our story. I want to share with you some pictures as we do this. So you should be able to see on your screens. I'm just changing my setup here so I see what you see. The first one here is a great picture. It's Andrew L. Wordle, and it's the Andrew L. Wordle Family Fund. Now, Andrew is carrying on a family's tradition of philanthropy that was begun by his father in Minnesota. In his new hometown of Fort Lauderdale, he's been very interested in helping lift up the youth and struggling families, and encouraged to partner with the Community Foundation by his professional advisor, Peter Anderson, his investment team at the Bank of America's private bank, as well as his attorney, Bill Snyder. Thank you, Bill. He as well has familiarity with community foundations from his time back in Minnesota, and he really has trust in the leadership here for the local community foundation. So it convinced him to partner with our philanthropic experts to help him feel a direct connection with his philanthropy, to have a more targeted giving strategy, and also to engage his young daughter, who you see here, Serena, so that she can learn more about Broward's big challenges and giving back to her community. As well as that, we're helping them explore how to make a real difference in the community. He established the funds by transferring monies from his community foundation funds in Minnesota and established 2 different funds at the Community Foundation of Broward. The first is a non-endowed donor advised fund where he can make current gifts. And the other is an endowed donor advised fund that he and Serena will be giving currently and into perpetuity. As well, Serena will be learning to become a philanthropist by doing that. So it'll carry on their values and their vision, as well as their tradition of philanthropy started generations ago, now in their new hometown of Fort Lauderdale. This is also a really good example of how the Community Foundation of Broward can be a great alternative to a private foundation. Now, speaking of private foundations, the next one I want to tell you about is the Judith Ann Linnell Foundation Fund. Judith Linnell was a native of Massachusetts, yet she loved the vibrant community and proximity to the sea of her new hometown of Broward. She was deeply involved in the Coral Ridge Yacht Club as well as the Navy League, and she was a regular at all society events. To ensure her continuation of giving in the arts, in civic engagement, and in education, she created a foundation in her estate plans, thanks to the excellent stewardship of her attorney, her advisors, Jim LeBate and Mary Connors, who were also trustees of the foundation. So at the foundation's sunsetting, Jim and Mary wanted to carry on the Linnell name in the community. So they made a $1 million grant at the termination of the foundation to create the Judith Ann Linnell Foundation Fund at the Community Foundation of Broward to carry on its philanthropic mission under Judith's name. So we often work with trustees who want to shed the administrative burdens of their family foundations, yet to continue the enjoyment of giving in the community. By choosing to convert their foundations to create a community foundation fund, it enables them to carry on their philanthropic missions without the hassle. This last person I want to talk about is Louise Weems. Louise had a passion for a cause, and that issue was animal welfare. Her dedication to animals began when she would bring in strays to her home as a youth in Richmond, Virginia. And then as an adult, she supported animal shelters and rescue units in different areas. But when she relocated to Fort Lauderdale, she met her husband, James, the one-time owner of Vanity Fair napkins, and together their elegant home became a refuge to their beloved pets. So her insightful attorney, Emily Tracy, helped create the Louise Weems Fund for Animal Welfare that was established in her estate. This endowed gift established a permanent support to provide spay, neutering, and euthanasia services forever, carrying on Louise's passion for animal welfare to go on forever. These are just three examples of, I'm going to stop sharing for a moment so you don't have to see this. Sorry. Of diverse philanthropic visions and philanthropic solutions that we came up with personalized at the Community Foundation for them. But now as things open up and the pandemic is receding, we look forward, as Kurt said, being out there and speaking with you directly, and hopefully together, we can come up with personalized solutions for clients for them to achieve their philanthropic visions in the community. Now, it's my pleasure to kick off the Best of Heckerling 2021 panel. As Kurt mentioned, we have an amazing panel that's backed by popular demand. This dynamic team of expert panelists and PAC members were introduced to you, but I want to tell you again. We have Adam Goldberg from Revis, Hervas, and Goldberg. Thank you, Adam. Jim Davis from Gunster, and Marianela Collado from Tobias Financial Advisors, as well as having Bill Snyder, who's our moderator from Snyder Snyder. Now, Bill has been a longtime PAC member, as you may know, but he also was a member and chairman of the Community Foundation of Broward board. And as Kurt had called out earlier, he had also co-chaired for the Community Foundation, the Joint Tax and Estate Planning Seminar in the past. But he's been leading this Best of Heckerling panel for years, and we're thrilled to have this team back together again. Before I let you go, I want to let you know that in the Q&A box, you can enter any questions you have during the presentation, and they'll all be handled at the end. So thank you, and Bill, it's your show.
Mark, thank you for the nice introduction. It's a pleasure to be here with you today. I have to admit, it's not the same as being in person. I think all of us that have attended Heckerling for years found that this year's session, the virtual session, really was a lot different than we're used to. The networking that you see at Heckerling is just phenomenal. Getting together with friends, discussing concepts, a lot of that was missing this year. And I feel the same way. Normally when we do the Best of Heckerling, we have a breakfast, a luncheon. It's always great to see everybody in person, but I have a feeling next year, and probably February, I think we'll hopefully all be together again in person for the next Best of Heckerling. So what we try to do is go through Heckerling and bring you the best topics, the best subject matter that we found. And this year is no different. I'm going to present our speakers here in order. I'm going to try to keep us on track. We have pretty defined time limits for our speakers because we want to try to get through everything. And we're going to ask if you would keep your questions till the very end. We've set aside 10 minutes for questions and answers. If you look at the bottom of your screen, you'll see a little button down there, Q&A. Feel free during the presentations to click on that. Kurt Zimmerman is going to keep track of questions, and then we will bring those up to the panelists at the end of the presentation. So with that said, I wanted to introduce our first speaker, Marianela Collado, who is a senior advisor and co-owner of Tobias Financial in Plantation, where she ensures that clients' financial planning objectives are pursued in the most tax-efficient manner. Prior to joining Tobias, Collado was a principal at Bessemer Trust and worked with the firm's client advisory team in Miami, providing wealth and tax consulting services. So Nella is going to be talking about income tax issues. The presentation was the first morning presentation. It was indicated that it was a fundamental program. It was anything but fundamental. The lecture outlined just for this session 368 pages of income tax material. So Nella is going to, in the next 15 minutes or so, talk about some of the important income tax issues that were discussed in this presentation. So Nella, the screen's all yours.
Thank you, Bill. Thank you, Bill. So I'm going to try to condense over 300 pages of materials in 15 minutes. So I think I think I'm fairly lucky, Bill, because as you may recall, we had been dealing with a client issue that it just so happened that they spent quite a substantial amount of time on that very topic just to answer my questions. So once again, the universe delivered. But basically, as you know, I've been dealing with this client issue involving a beneficiary of a marital trust whose remainder beneficiaries are children of her deceased husband. And these children and the co-trustee, who happened to have been the decedent's brother, were making my client's life pretty miserable. She couldn't even access the income which she was entitled to. And every time she submitted a receipt for medical expenses, they were scrutinized. So long story short, what my client ended up doing was hiring an attorney and trying to settle out the trust. So they did reach a settlement agreement where they would pay my client the cash value for her income interest in the trust. So the question became what does this payout of her income interest represent to my client? And so Attorney Berry in the morning spent quite a substantial amount of time going over the application of the uniform basis rules as it applies to the sale of an income interest in a marital trust. So under the Internal Revenue Code section 1001E1, if you got that, an income interest in a marital trust has no basis. And you look at basis when you're looking at a taxable exchange. So what is a taxable exchange as it relates to a an income interest in a marital trust? So basically, that is a payout of an income interest. It's deemed a sale because the income beneficiary is exchanging the value of her income interest for their interest in the total trust. Or said differently, the remainder beneficiaries are buying out the income beneficiaries so that they can access the remainder of their trust today. So what you're doing is exchanging one type of asset for another, one being the income interest in exchange for the remainder. So typically, the way that you calculate the value of this income interest is you would look at the life expectancy of the income beneficiary and you apply the 75/20 rate. So I remember, Bill, we were kind of going back and forth and saying, we understand this is a settlement, but is it taxable? So the question is, yes, this is actually treated as a capital asset. And whether it's short or long actually depends on the time that the marital trust is actually established and the payout. So as an example, if a person passes away today, sets up a marital trust, gives spouse an income interest, and then 2 months later, they decide they're just going to settle this out, that would actually be short term because 12 months haven't passed since the creation of the marital trust and the exchange. In my case, we actually discovered that it was long-term. So it was long-term capital gain on that settlement of her income interest. But what they did talk about were some possible solutions to avoid what seems, even to my client who said, this is so unfair. You're just telling me that I'm going to pay income, I'm going to pay a capital gains tax on a distribution of that I would otherwise not pay until later on, until, there's income in the trust and it's passed out to me. And I said, this is exactly what the code says. I don't make it up. It's just what it says. But they did talk about some solutions here, which I thought were pretty creative, assuming that everyone gets along and they're able to make these changes. So one was amending the trust so that both the current and the remainder beneficiary have the same kind of interest. So in other words, giving the current income beneficiary access to principal. But of course, in my situation, that wouldn't have worked because the remainder beneficiaries didn't get along with the income beneficiaries. And please feel free to chime in, attorneys, if you have anything to add as I go over this. Another solution that attorney did suggest was possibly giving the beneficiary a power of appointment, and these were things that would have to be drafted beforehand. But if someone is a power holder, they might be able to appoint principal to both the remainder and the current income beneficiaries so that, again, they both own the same thing and there's not an exchange of one type of property for another. And then the last option would be just decanting the existing trust into new trust if they would all get along. So that was kind of interesting. And the most exciting part for me was that I've been dealing with this issue for about 2 weeks, and then there is my answer. So the other thing I wanted to jump into, which they talked about at length, was the toggling of grantor trust status as it relates to an intentionally defective grantor trust. So as you may all know, if you're turning off grantor status in a defective grantor trust while the grantor is still alive, you may have a taxable event if the balance of the debt exceeds the basis of the assets that were initially purchased by this agent. So in a typical situation, that would be the case because you're generally transferring a low basis asset. You sold it to the trust for a note. That fair market value presumably would be higher than the basis. And so if you end up turning off grantor status before you bring down that note balance and it happens to exceed the basis of the property in the trust, again, that triggers a taxable event. What they did talk about was they confirmed that the death of the grantor does not cause a realization event. So if the grantor does die, it doesn't matter that the balance of the note is in excess of the basis. It would not create a realization event. One of the things that they talked about, which seems to be a gray area, and some practitioners feel like it does apply and others don't, they talked about whether the assets inside an IJIT would be able to get a step up in basis. And Tierney's feeling was that this is one of those areas where we really shouldn't try to get greedy. They boiled it down to bottom line, if the asset is includable in the grantor's estate, then it should get the step up. But if it isn't, then that would just be kind of pushing the envelope. And I don't know if you guys have any thoughts on that, which I do agree. I think it would be pushing it to try to also get a step up in basis on top of the assets being outside of your estate.
Nella, I think they indicated that's pretty much the standard procedure of most attorneys.
Right.
Treat it that way.
So one interesting concept was the ability to actually go the other way as it relates to trust, going from a non-grantor trust to a grantor. And you thought, how would that even be possible? But essentially, that would be the case of possibly the grantor marrying a trustee, that the act of both, having that much control where the grantor marries the trustee, that would convert a trust from irrevocable non-grantor to a grantor trust. And this typically applies for same-sex couples. So that was an interesting planning opportunity if you ever needed to convert a non-grantor trust to a grantor trust. Since I have a little bit more time, I'll jump into some basis transfer. Paulie, he talks very fast, but he did talk about a couple of things related to gifts of discounted FLP interest. So as you all know, generally when you go into a sale or a gift of a minority interest in a family limited partnership, you're getting a discount on that interest. So one of the things he talked about is that if you are selling or gifting, say 45% of an interest in an asset that is discounted, you can't just apply that same percentage to calculate the basis that carries over to that entity or to that donee. In other words, if you transfer 45% interest in a family limited partnership, but the discounted value is going to be much less, you actually have to take the discounted value over the total value of that asset, and that's the percentage of the basis that carries over to the donee, which I thought that makes sense, but I figured, people might think that it's the same original 45%, which is not the case. They also talked at length about using a partnership to shift basis inside a partnership where you have assets that may have, some assets may have low to no basis and others have higher basis. So doing a 754 election and a corresponding 734 adjustment inside the partnership to allocate that basis across all of the assets inside of the partnership. And we have that material if anyone wants to read it. It goes kind of really deep into the weeds on that. Another thing that I appreciated hearing, because it was a question we were getting constantly with some of the tax proposals, was with this idea that capital gains would go up to 39.6 for any gains realized in excess of $1 million. Their view was similar to what we've been telling our clients, is that I wouldn't go crazy just triggering gains for the sake of triggering gains. However, if someone does have a sale, possibly a sale of a business that they were thinking of doing anyway, then it might make sense to try to accelerate, which is our view here at Tobias in terms of what we're recommending for this potential change. And I like one thing that Sam Donaldson went into. He was covering what I would refer to as tax bloopers. Oftentimes our clients spend so much time working with us and creating these fancy strategies, either for charitable gifts or wealth transfer, but they try to cheap out on appraisals. And one of the things he said is that's not you don't want to fail and have the entire gift blown on account of just not paying a little bit more to get the right appraisals, which at the end of the day, the IRS will look for, either with respect to a charitable deduction or if a gift tax return gets audited. So making sure that we're advising our clients that the appraisal is not the area that they should try to, save a little bit. It's actually what's gonna make sure that gift starts the statute and doesn't get challenged by the IRS. And I have about 1 more minute. So I attended the ESG session. We weren't going to go at length, but one of the big takeaways, which to me resonated, because as usually a trustee is hiring us to manage assets for a trust. So they talked a little bit about this concept of doing well while doing good, but they warned trustees that if you're trying to invest in a socially responsible way, you cannot do it in a way that prevents or provides collateral benefit. In other words, you can't say, I'm not going to invest in these companies because they are polluting the air, and so this is bad for the environment. Actually doing that would just be strictly illegal. So it's something that we should just be aware of, that we're advising these trustees that if they're making that call, it is against their fiduciary responsibility. They have a fiduciary responsibility to the beneficiaries. One thing that they could do is, if they wanted to take on a socially responsible investment portfolio, more along the lines of a risk-adjusted approach. So because these companies are socially responsible, they are projected to have a higher rate of return, something to that effect. So I think that about takes up my time. So I'll pass it back to Bill.
Good. Nella, thank you so much. Our next presenter is Adam Goldberg. Adam has an LLM in estate planning from the University of Miami, where he now serves as an adjunct professor in the LLM program. He practices law in Weston. And Adam, the screen's all yours.
Thank you, Bill. The first time I was ever on this committee, I remember you asked me, what are the things that I learned at Heckerling? I learned 3 things at Heckerling this year. 1, I'm a lousy online learner. Much like Bill alluded to before, I despise that process. Number 2, I learned that never agree to take 275 pages and a 3-hour presentation by some of the biggest names in estate planning and turn it into 15 minutes. And number 3, don't worry about the unified credit right now. Worry about capital gains and the step up in basis. That is where they spent the bulk of the time. So what I'm going to try and do in the 14 minutes I have left is I'm going to try and go through some of the legislation that's passed, some of the legislation that's proposed, and then until Bill cuts me off, anything else that the speakers thought to spend some time on. So I'll start with the Secure Act. I'm sure just about everybody on this call, on the Zoom call, knows about it. You'll know that we changed the required minimum distribution age from 70.5 to 72. We know that we're now allowed to make contributions to an IRA after 70.5, that if you just had a child or you newly adopted a child, you can take $5,000 out of your retirement account with no penalty withdrawal for the parent or parents. And the 10-year distribution rule, of course, with some exceptions for spouse, special needs beneficiaries, or other beneficiaries older. So those we should all know by now. Those shall be old hat. Other one that passed already was the CARES Act. 2 things that you may not have known about the CARES Act. Number 1, for our females in the group, feminine hygiene products, even if they don't need a prescription, are now allowed to be taken from your health savings account. So that's something new. It's a change to Code Section 223. And, they were kind enough to bring that up. And also, employers are now allowed to make student loan repayments to employees of up to $5,250 a year. And that's done on a tax-free basis. So if we have any lawyers out there looking to try and hire and give some bonuses, all of those law students with loans would love to know that that code section. So please consider that. Now let's talk about proposals. I'm going to talk about the ugliest one first. Now, everybody on the panel, and we had Steve Akers and Sam Donaldson and Sarah Moore Johnson, and we had materials were provided by Sam Donaldson and Jeffrey Pinnell and Howard Zaritsky. Nobody thinks that Bernie Sanders' bill is going to pass, but we should still know it. That one's called For the 99.5% Act. It is a back again version of what he first proposed in 2019. What he basically wanted is gift tax coming back at all gifts over $1 million exemption during your lifetime. He's proposing a 45% estate tax rate from between assets of 3.5 million to 10 million, a 50% estate tax rate from 10 million to 50 million, a 55% estate tax rate from 50 million to $1 billion, and any estates over $1 billion, a 65% estate tax rate. What that would also mean, although his bill doesn't say it, is a 65% tax rate for GST. And believe it or not, these are the more moderate versions of it. At one point in time, this had a 77% tax. Things to be noted, the effective date was not passed. In other words, this is not, you're going to have time to know if this ever came into fruition, unlike his earlier version of it. So it's not immediately. In addition, in this For the 99.5% Act, no up in basis at death for grant or trusts, no discounts for non-business assets in a family limited partnership, which would be a new code section or a new version of 2031 D1, which would really clamp down on the use of family limited partnerships. Requiring grant or retained annuity trust to be a minimum of 10 years and have the lesser of 500,000 or 25% of the underlying asset left at termination. A change of the inclusion ratio for GST tax purposes in long-term trusts, anything over 50 years. That would make a lot more GST tax due. And getting rid of crummy powers. So you not really caring about the present interest version of a gift, so leaving the $15,000 annual gift tax exclusion, but having a new annual gift tax exclusion of 2 times that, so $30,000 for any illiquid assets. Now, if any of you had a heart attack or fell on the floor or started crying, let me remind you, nobody expects this to pass, okay? But it has been, presented to the Senate. So remember, something similar was presented 2 years ago. It didn't go anywhere, but I thought you should be aware of it. Now let's talk about the STEP Act of 2021. STEP stands for Sensible Taxation and Equity Promotion Act. Again, this has been submitted. We do not know if it's going to go anywhere or not. There is a House version of this one and a Senate version of this one. So there is, at least in both houses. One of the big ones here would be a new code section 1261. That would be a taxation of unrealized appreciation in gifts, bequests at death, or certain ownership changes. If you sell it, if you gift it, or when you die. So if you had, basically an asset that was worth $300,000 when you bought it, and you died and it was worth $30 million, and you left it to somebody, they want to tax it as if you sold it. Believe it or not, the House version of this bill is retroactive. It would go back to, the House version is not retroactive. It would be dated 12/31/21. The current Senate version is retroactive 12/31/20, but it was brought before 12/31/20, so they're not sure if that's really what they want. I don't think anybody on this phone call is old enough to remember, but there was something similar to this back in 1976. It lasted about 4 months, and there was something called a fresh start offered at the time. In other words, they were only going to give you capital gains inclusion. They were going to give everybody a basis from 1976. That law actually passed and was such a misery, they ended up repealing it very quickly. But this versions that we're seeing right now have no fresh start, which would make it very difficult to try and prove what is the basis on a lot of things. And the panelists at the recent developments spent a good amount of time talking about how difficult that would be, and how would you prove things to the IRS. Assuming all this went through, it would all be reported on a decedent's final 1040. There would, of course, be exceptions for spouses, although the question was, would the exceptions be for just U.S. citizen spouses? The panel thought it would be U.S. citizen spouses and green card holder spouses, but green card holder spouses wasn't in any of the legislation so far. Charities would be exempt. There is in both the Senate and the House version a $1 million exemption indexed for inflation for annual exclusion gifts. They would let you pay the tax off in 10 years, so you wouldn't have to pay it immediately. There doesn't appear to have any effect on estimated taxes. And one interesting thing for our CPAs out there, appraisal fees would now be an easily deductible cost. It would not be considered a miscellaneous itemized deduction. So that's the STEP Act of 2021. Very different. Don't know where it'll go, but something we certainly want to pay attention to. Let's talk about another proposed legislation. This is called the Made in America Tax Plan. The Made in America Tax Plan, the big one here is that C corporations, raise the tax rate from 21% to 28%. In addition, there would be strengthening of a global minimum tax for multinational corporations. There would be a 15% minimum tax on large companies reporting high profits but little taxable income. So if you have any of those publicly traded companies and you get the annual report and you see, hey, look at all that money we made, but we didn't pay much tax, this would be a remedy there. This would also replace fossil fuel subsidies with clean energy incentives, which was interesting, and looking to fund more tax enforcement, so more money to IRS to go after big multinational and big C corporations. So that's the Made in America Tax Plan, more of a corporate tax issue. What else? They talked about a few other things. One of them was the American Families Plan. The American Families Plan, as Nela just told us, would bring the ordinary income tax rate back up to the highest rate, back up to 39.6%. In addition, if you had over $1 million of income, you would not be able to use the capital gains tax rate for that year. So that would be interesting. It also would pay for national preschool for 3- and 4-year-olds and 2 years of free community college. It would also eliminate like-kind exchanges for over $500,000. It would eliminate the step-up in basis for all those individual filers at $1 million and for married filers at $2.5 million. It would extend the child care credit and make it permanent. One of the more practical ones, but it's in a house-only version, is the required minimum distribution age would go from 72 to 73 in 2022. It would go to age 74 in 2029, and it would go to age 75 in 2032. Interesting thing to note about that is getting bipartisan support. So that could get tacked on to something else. So be on the lookout for that one. Other things that are mulling around up in Washington, D.C. would be certain organizations of certain sizes would have automatic enrollment of 401ks with the employees having to opt out as opposed to what we have now where they have to opt in. There would be small firms would get a large credit for adopting retirement plans, a large tax credit, increasing the amount of money that ages 62, 63, and 64 could put in their IRA, just like we have now, but with another one. And then one of my favorites, the $100,000 qualified charitable contribution distribution that you're allowed to give to charities every year would be indexed for inflation. So that would be very nice. We are finally starting to get clients that are taking advantage of that, even though this past year, since you didn't have to take the required minimum distribution, we didn't see that. So those are bills that were either recently passed or are pending somewhere in the House or Senate or discussed or coming out of the White House on things to watch for. There wasn't a lot of thoughts that anything is close to passing, but certainly we want to watch these. Everybody in Washington, D.C. is very mindful of the retroactive nature in things, so they don't think anything would be retroactive. You could have for my attorneys out there, you could have a lot of people coming to do slats all our married couples running to do slats at the end of this year. So don't book any big trips for December if you think any of this legislation is going to pass. Other things that they talked about. There was some great discussion on planning for a low interest environment. They were very focused on the fact that the 75/20 rate in May was still only 1.2%. They went through a whole great presentation on what would be the advantage of doing a 2-year GRAT. They also talked about doing a 99-year zeroed out GRAT, because you know what the 75/20 rate now is, and you can't imagine that when the person actually dies, the 75/20 rate being as low as it is now. They also asked you to consider doing zeroed out charitable lead trust for your client. Again, all of this is excellent in the low interest rate environment. One victory for public support came to us from code section 642H, and it was actually the new regs for 642H. The IRS actually heard the outcry of the public, and they eliminated the 2% haircut for excess deductions in a final year of a trust or estate. This was important relief, and again, the panelists were really excited because the IRS took one position and everybody's comments were on the other side. So when they came out with the final regs here, it really was a victory for the taxpayer. So that was really good. Something they spent some time about was estate tax closing letters, or really the lack thereof of estate tax closing letters. New proposed regulation 300.13, where there'd be a user fee of $67 in order to request an estate tax closing letter yet. Not sure on a process or how to pay it. The panelists guessed that it would probably be at pay.gov, which is kind of the IRS website that they've been using a lot more. And also remember that private letter ruling requests, the fee went up to $38,000 from $30,000. So we are going to see a lot of jump in the costs on what the IRS is doing. There was some good discussion on the IRS S tables.
Adam,
Yeah.
Adam,
Yes.
if I could, soon we need to move on here to Jim.
Okay.
I think your time's pretty much up.
Okay.
If you're right, if you want to finish something, please go
let me
ahead,
just finish. If I had more time, we would talk about gifts versus loans, the new IRS S tables, the Campbell case, the Moore case that recently came out, trust protectors, the state transfer tax system, and the 8 states that still have common law marriage.
Awesome. Adam, thank you so much. Our next speaker is Jim Davis. Jim is a shareholder, of course, at Gunster, where he is a co-practice group leader of the firm's tax practice group and serves as general counsel for ERISA. And I know we all know Jim as one of the foremost experts on retirement accounts. And so with great pleasure, Jim, the screen's all yours.
Thank you very much, Bill. I don't know about all of you out there, but after listening to Adam, I'm kind of depressed. That's scary. And I hate to admit it, but I remember the carryover basis days in 1976. Those were the Jimmy Carter years that we probably will now be calling the good old days, but that remains to be seen. My topic deals with Secure and consequences of what happened with Secure. The presenters were Chris Hoyt and Natalie Choate. I was asked to kind of follow Natalie Choate's outline as well as Chris Hoyt's. It's very difficult to follow someone like Natalie Choate, if you all know who she is. And I thought probably the only way that I could probably get close to emulating her was following what she did on her presentation, if you saw it. And that was starting with a beer and a straw. Now, having said that, you'd have to see the presentation to understand it. Now, this one's not opened simply because it's just too early for a beer. It's not 2 o'clock yet. So we'll get into the presentation instead. Both Natalie and Chris touch base on the consequences of the 10-year rule. In a nutshell, both presentations, both entire presentations are the result of the 10-year rule that was implemented by Secure. Specifically, how do you get around it? We'll talk about that in a minute and just kind of go through the basic ideas and concepts. But a couple quotes from Natalie as a result of Secure and the 10-year rule. the planning for RMDs is now more complicated and less rewarding. The good news is there is less to lose, parenthetically, if you screw up. There is no grand strategy available. So in other words, there's no silver bullet to get around this 10-year rule. Instead, it's pretty much just damage control. So what we're really talking about are RMDs, required minimum distributions under 401(a)(9). And the changes in SECURE have accelerated the required minimum distributions, and that's presented a lot of problems. There are two types of RMDs. There are lifetime RMDs and there are post-mortem RMDs, but everything focuses around these required minimum distribution requirements. Why are they important? Well, if you don't distribute the required minimum distribution, there's a 50% excise tax, non-deductible. Now, there's a bill pending called SECURE 2 that is going to be reviewed later this year, but if that passes and the provisions remain the same, that 50% excise tax is going to go down to 25%. As far as RMDs during lifetime, there really have been no changes. They're pretty much the same as they were. Now, there is a new annuity table that will be effective next year. And Chris Hoyt said that's going to probably decrease the required minimum distributions by 1/3 to 0.5%. Not a big one, but nevertheless, it's going to help a little bit. The required beginning date, of course, is now age 72. First distribution has to be by April 1st of the year following attainment of age 72. But the general rule is that the lifetime required minimum distributions pretty much are the same. And that is that from a traditional IRA, that distribution is generally taken over the grantor's lifetime. If there is a spouse that's 10 years or more younger, then they can use joint life expectancies. If it's a Roth IRA, there are no required minimum distributions during a lifetime. If there is a 401(k) plan or some other type of qualified plan, and if the plan permits it, then for 5% owners who are not 5% owners, those distributions can be postponed until retirement, whenever that might be. So those are important to consider, but most of the planning is going to take place within IRAs. They're not going to take place from or within a qualified plan. Qualified plans tend to be too restrictive in distribution options. So generally, that's the lifetime distributions. The 10-year rule applies to post-mortem distributions as the general rule. Used to be, if you retained your required beginning date, you could take distributions over the lifetime of the designated beneficiary or over the ghost life expectancy, as they call it, of the decedent. Ghost life expectancy was the annuity table life expectancy as of the date of the individual's death. So that used to be the general rule. You could take him over the longer of the two. No more. The general rule is that all distributions from an IRA or qualified plan must be distributed in full by the end of the 10th calendar year following the calendar year in which death occurs. And so that could be as much as 11 years. And there is no requirement that the distributions come out equally each year or unequally. You can wait until the last day of that 10th year to make distribution. So there's some planning opportunities there. But the problem is that if you do that, obviously with any large IRA, you're going to have a fairly substantial increase in the beneficiary's tax brackets. There are exceptions to this 10-year rule. The 10-year rule pretty much it governs distributions after the required beginning date. For distributions that for death that occurs prior to the required beginning date, the 10-year rule applies unless there is no designated beneficiary. A DB is an individual. So if you've got an estate or trust or a charity, that is not an individual, and that's going to trigger the 5-year rule. That means that everything must be distributed by the end of the 5th calendar year following date of death, if death occurs prior to the required beginning date. So the main thing is to just be careful of who the beneficiaries are. If you have an entity that is not a designated beneficiary, there is a determination date of September 30 following the calendar year of date of death, by which time, if you make distribution out of the IRA to that non-DB, then you can pretty much disregard the entity as a non-DB and look solely to the individual designated beneficiary. Then the 10-year rule will apply. There are different types of beneficiaries. One of them is called an eligible designated beneficiary, or EDB. An EDB is one of perhaps 5 different categories. There's a minor child, there is a surviving spouse, chronically ill, disabled, and a not younger than 10 years. And I'll explain all of those in terms of how they apply. If you have an EDB, then you can use the life expectancy of that EDB, very limited in utility. If you consider that a minor is an EDB and you're going to make distributions over the lifetime of the minor up until majority age, whatever that might be, remember there's a kiddie tax. Kiddie tax is the same as the trust and estate bracket. So you're not getting much benefit there. They're going to be taxed at very high brackets. Upon attaining majority age, then there's going to be a 10-year rule that then applies. So there'll be another period within which distribution must take place. The use of trusts is something that people are really focusing on. But if you remember what we did last year, if you attended, when you work through the trust tax brackets or the kiddie tax brackets, or make distributions to a designated beneficiary who's already in a high income tax bracket, the actual after-tax amounts left, whether you make distribution at the last day of that 10th year or equally or to accumulation trusts, they're going to be pretty much the same in terms of what's left over. And there's not going to be much difference. There's not much you can do to get around that. Now, the one thing about using trusts is that it maintains control, or I should say, prevents the beneficiary from unilaterally accessing the IRA that's made payable to the trust. If you do use accumulation trust, it's got to be a see-through trust. A see-through trust is a trust that has just individuals as beneficiaries, not entities. Natalie Choate spoke about a toggle trust, and that is a see-through trust that is the beneficiary, where that trust doesn't have to elect the 10-year rule if there is a longer life expectancy available. For example, the ghost life expectancy. One of the things that Natalie addressed was in publication 590-B. That's a summary of IRA distribution requirements. Now, in that publication, regulations have not yet been issued. It does appear that on page 12, there is a reference to the 10-year rule being applied after attainment of the required beginning date, but not the ghost life expectancy. The ghost life expectancy on an earlier page, though, does appear to apply to distributions to a non-designated beneficiary after the required beginning date. So what does that mean? Well, it appears, at least in terms of the 590-B publication, that if you have a non-designated beneficiary, then you can use the longer of the individual's life expectancy remaining, the ghost life expectancy, which is about 15.5 years at age 72, or you can use the 10-year rule. And so you have the ability to, in a trust anyway, maybe toggle that on and off. I think it remains to be seen whether that ghost life expectancy is going to be used. So planning, what do you do in light of secure, and how do you deal with these things? Well, Chris discussed use of a charitable remainder trust as a beneficiary. And actually, Bill Snyder, to his credit, back in 2005, we were talking at a presentation, and he mentioned use of a charitable remainder trust as a beneficiary. And why is that beneficial? Well, you can make distribution of the IRA to the CRT. CRT is tax exempt. So you can make distribution on day one, the entire amount, zero tax being paid. Then the beneficiary will receive distributions over a period of time, as long as you're compliant with the 5% rule and the 10% rule. And if you can do that, then you can probably stretch that distribution out to the beneficiary for a much longer period of time than merely the 10-year rule. Now, there are some constraints with that. And as Hoyt had mentioned, it doesn't really work for minors. You kind of have to have someone that's in that kind of a sweet spot, perhaps 30 years old, and then you use a 20-year term CRT, and that's a possibility. But also, one of the luncheon presentations, actually it wasn't really a luncheon, it was during lunch, but nevertheless, it was quite nice. And that was by Sterling, Evan Unzelman. Evan Unzelman, of course, with Sterling, they specialized in CRTs and exempt organizations. And his presentation dealt with CRT and distributions of IRAs to CRTs. Well, his point is that if a CRT is a capital asset, if you hold on to it for a year, so you sell that income stream after a year and you actually can get capital gains treatment. The value of the CRT is based upon AFR rates and the future stream of income. But he's gone one step further, too much to discuss here, but that's a CRT rollover, where the income stream of the newly created CRT is transferred into, from the existing CRT is transferred into a newly created CRT. You hold on to the CRT for a year, then sell the income interest, which is a capital interest. And now what you have is capital gains left in the CRT. All distributions that come out are capital gains because there are no ordinary income items. So it's an interesting concept. I haven't really used it, but it is certainly something to give some thought to. Kind of moving on, mostly to Natalie Choate's commentaries, which I thought were very, very good. The issues surrounding designation of beneficiaries for IRAs really involve control and tax brackets. It is a tax bracket management consideration. So you look to the beneficiaries and see how can you get the best for the tax brackets. I have found that if you have an IRA and you have individuals where there are to be cash distributions, pecuniary distributions from the IRA, and those individuals are in low tax brackets, then that may be the best way to fund those legacies to low income individuals. Use a Roth IRA and or other assets to benefit the highly tax bracket beneficiaries. This is something to consider. Accumulation trust. Last part of what Natalie discussed was accumulation trust. And I thought it was very interesting because she had 7 tax facts dealing with accumulation trusts. Now, these are see-through trusts into which the IRA benefits are to be distributed, where they will actually accumulate these distributions of income, and income can be distributed from the trust to the beneficiaries. Now, contrast that to distributions from the IRA as opposed to distributions from the trust after distributions to the trust from the IRA. Totally different concepts. It's a real eye-opener. And the reason for that is that the way D&I is computed and distributed are totally different depending upon how you structure the distributions. In an accumulation trust, you have to be very, very careful how you're structuring the distributions. Her comment was, permit the trustee to make distributions of both income and principal well beyond the RMDs. Let the trustee have discretion. Secondly, use a good definition of income. Income for federal income tax purposes, for example, or the examples that are found in a revenue ruling, 2006-26. Very, very important. Depending upon how that accumulation trust makes distributions to beneficiaries, whether they're pecuniary distributions, separate shares, or percentages. Sometimes D&I is not going to flow out of that trust to the recipient beneficiary. Pecuniary distributions generally don't receive D&I distributions, and consequently, they're not taxable, and the income tax is trapped at the trust level, and the remaining beneficiaries get to pay those taxes. Real eye opener there. There was another presentation, don't have it in front of me, but a very excellent presentation on D&I, how it's computed, and the rules, very complicated. Frankly, I just call Bill if there's a complex D&I question. The easiest thing to do. So we have a couple minutes left, but I think the main thing to keep in mind is that the 10-year rule is going to really restrict how much you're going to be able to leave to beneficiaries on an after-tax basis. So look at the beneficiaries, look at their tax brackets. Are they EDBs? Do you want to use a trust? Trust may have some benefit here. I never used to like trust, but accumulation trusts might very well have some benefit. But if you do use accumulation trust, do keep in mind that the distributions of D&I are a very complicated matter, and they have to be structured properly. If you have a traditional IRA, consider converting it to Roth. Roth doesn't have the D&I distribution problems, but I think the problem that's going to happen there is that it's a very low-hanging fruit. And I've always thought that the Roth IRAs are going to be the next hit on the tax law changes. So in a nutshell, that's kind of a very brief summary of what Hoyt and Choate presented. Their materials are excellent. I would commend you to look at them. They're not that complicated. And thanks for attending today, and hope you pick something up. Bill, it's yours.
Jim, thanks for a very well organized presentation. A lot of material was covered, and thank you so much.
My pleasure.
Our next presentation, which is fairly short, just about a 5-minute presentation, I think is important for all of us, and that is in this COVID world, dealing with the whole issue of confidentiality. There was a nice presentation about that, and Adam's going to spend a few minutes and talk about that.
Thank you, Bill. This one was very lawyer incentive discussion, but I'm going to try and pull out the things that would affect everybody. I think my favorite part of this presentation, and I was not a fan of The Sopranos, was the fact that the Tony Soprano rule that a lot of states have developed now. This works a lot in family law, but it also potentially could work for asset protection. And that was apparently Tony Soprano visited every divorce attorney and all the good divorce attorneys and paid a retainer, and therefore every single divorce attorney in town was not available for his wife to use. And so, that's kind of where the jumping off point was for this presentation. What they spent a lot of time on is, don't forget that for your electronic security measures, you have to use all the same rules as you would for anything else. So you need to make sure that you're taking those reasonable measures and that you're doing your due diligence there. Consider, is your microphone on? Is your camera on? Should your camera be on? Should your microphone be on? What's on your desk during a Zoom call? Unfortunately, you can see my desk, but every file is turned upside down. So if there's anybody out there that could have really good eyesight and read anything, you should not be able to see anything on my desk. They also talked about how do you destroy old cell phones and tablets that you used for work that you may not normally use for work. If you're using flash drives now, are they password protected? What do you do if a flash drive is known to be lost? What is your policy? Do you have a shredder that you're using at home if you're working from home? And not only you, but is your staff aware of all of these rules? One of the nice things in Florida is most firms have a hurricane policy. Obviously, this is a little different than that, but hopefully you're using that hurricane policy and you've been able to turn it into a COVID-19 policy. So are there special rules for a pandemic or after a hurricane? They stressed for diligence, the job does not stop because you're working from home. How are your clients supposed to be reaching you now? Do they know that they can't mail things or overnight things to the office? I know that one of the big financial providers here, if you wanted to make deposits to your account, there was only one office open that you could send it to. Not every office was open. So how are you getting that information out there? Are you using proper safety, security, and malware protection when you're at home? And don't forget about succession plan. Unfortunately, in my office, we do have 2 attorneys that passed away from COVID, 2 accountants, and 1 financial planner. So Florida attorneys are required to have an inventory attorney. I can't tell you what those rules are for CPAs or CLUs or financial advisors, but keep that in mind. Are you able to accept mail? I mentioned. They talked a lot about technology, have written policies, make sure you're checking on your vendors, and regularly and repeating checking on your vendors. Supervision just doesn't mean hiring the person. It means making sure that the people that you hired to provide these are something that you keep in mind. And the last thing was unauthorized practice. If you're an attorney who chose to spend COVID-19 in Wisconsin, but you're still practicing law, are you violating the unauthorized practice of law? So they got into a whole discussion on that. So since I went over, I'll go under here, but those are some of the things. I realize I provided you no answers, but just things to think about, for the way that you practice and the way that you work. Thank you, Bill.
Thank you. Nella is going to present just a few minutes on diminished capacity and non-U.S. spouses.
Excellent. So I'll be brief here. I just thought it was important as we're dealing with aging clients here in South Florida. I keep telling my clients I need to plan to 100, and most of them think I'm crazy, but it's because people are living a lot longer. So we know that as a result of people living a lot longer, we're having to deal with more cases of potentially diminished capacity. So some of the recommendations for all of us working with clients and as maybe the front line of professionals who are able to notice that these things are happening is making sure that we're proactively coordinating with our clients' other professionals to make sure that basic documents are in place. Healthcare directives, living wills, HIPAA authorizations, trust if they need it, powers of attorney. And more importantly, this is something that we do for our clients. We have what's called a sides agreement, a sharing of information during emergency situations. It's not necessarily a power of attorney, but it's just a document that allows us to call a family member or a friend if the client is making a request that seems to be off, right? If they're calling, asking for a wire to a Cayman account, and the client has no ties to the Cayman Islands, this would be a perfect reason to call the friend, call the family member, and find out what is going on. So that's something that we do proactively. We're not waiting to see signs of diminished capacity. We're having that form signed up front, and clients actually appreciate that we're proactively thinking of these things. Another thing that they talked at length was us being frontline, able to notice some of these things is look out for signs of diminished capacity. Are they having trouble speaking? Are they getting lost in your office? If they come in and they've been there many times, do they look like they're getting anxious if you're asking them questions, or quickly going from laughter to tears? Things that we typically know, but really us dealing with clients on a daily basis, we're in a good place to notice some of these things ahead of time. We had a client situation where the son became aware of the mom's diminished capacity, actually kept it to himself, and then took advantage of mom after stealing millions. So this is where if he was seeing attorneys or going to the bank and requesting distributions with the son, where the son would say, right, mom, do you want to transfer 400,000? And these clients, one of the things that they said is, if you ask them questions where the answer is yes, you're going to get a yes, because they say yes to everything. So just making sure that you're asking questions that don't require a yes response. So that was some of the things that they talked about. I love this part. They talked about ways to protect ourselves when we're working with clients who could eventually show diminished capacity. Recording the interview, maybe having them record their wishes, and record you asking them if they're aware, what's the date. These are things that we may not think about today, but can come back and bite us in the you know what. So, you know, they talked about the importance of working in multidisciplinary teams. We believe in collaboration. I think the best thinking happens when we all work together, and they stress that again. And that was it on diminished capacity. So for the next 2 minutes, I'll talk about some planning ideas that they covered for those who are married to non-US, who have non-US spouses. As you all know, non-US folks don't have the same ability to apply a marital deduction or the exemption levels as we know them for US people. So some of the planning that they talked about is making sure that what you're passing on to your non-US spouse, possibly pass that in using a qualified domestic trust, which allows that to be protected from that much reduced exemption. So as you may know, the QDOT will qualify for a marital deduction, right? Not if it's going to the spouse. Allows for the spouse to pull out income during life. And the only time it gets slapped with a 40% estate tax is on distributions of principal. But one of the nice things about using a QDOT is if that non-US person does end up becoming a US citizen, before that gift tax return, the state tax return is filed, you may not need the QDOT. It gives them time to plan ahead or just dismantle the QDOT at that point. So that was something to keep in our back pocket if we're working with clients who are married to non-US folks. And then lastly, they covered some quick warnings on foreign bank account reporting. I'm sure we all know this, but it's a good reminder. They are now actually pursuing professionals who are advising clients to not report these accounts. And they should know that the client gets slapped with a 25% penalty for failing to report a foreign bank account. I'm sorry, for failing to report a gift from a foreign parent or a grandparent. And this is a question we get often. We have people that have family back in South America. If they're getting a gift from a parent or grandparent, it's a simple disclosure to just show that the person received a gift from a non-US person. But if they've been named in a foreign bank account, again, simple reporting. If failure to report that foreign bank account carries with it a penalty of up to 50% of the account value or $100,000. So that is my time. I know they did say you don't have to report crypto as you do a foreign bank account, but we are seeing more guidance from the IRS that they're looking to have a little bit more oversight over crypto transactions. And that's it, Bill.
Ella, thank you. Thank you so much. Now is the time for some questions. One question was for Jim. Jim, when you have a trust as a beneficiary, let's say of an IRA, and then that, let's say, revocable trust splits off into 3 sub-trusts, let's say for minor children. So you have call it the main trust. It's in existence for a short time, breaks off into 3 sub-trusts, let's say for either adult or minor children. Would the 10-year rule apply, or is that the 5-year rule? That's the question.
Well, if by September 30, those separate share trusts are separated so that you have got an EDB, the minor child, as the beneficiary of each one of those 3 trusts, if I understood the question correctly, then you could elect to use the life expectancy rule through the date of majority, and then the 10-year rule would cut in. Or you could use the 10-year rule from day one. You'd have a choice.
And if I may chime in, I think you still need that conduit language, which is a question we keep getting. Do you need to worry about conduit language in a trust now? You still need the conduit language. And Jim, you can confirm that for us.
Absolutely, absolutely. That deals with how you structure the terms of the trust, and It was focused more on the individual designated beneficiary, but in order to use that individual's age, whether it's a minor or any EDB, you do have to use a conduit trust. Conduit trust is a see-through trust, but a trust that mandates distribution of all RMDs that the trust receives. Natalie Choate's point was, don't stop there, permit distribution of principal and income beyond the RMDs. But yes, that does have to be a conduit trust.
So if it was let's say it was an accumulation trust, in that case, how would it change? How would it change the 5-year or the 10-year rule?
Well, if you had individuals, all individuals as the beneficiaries, and it was accumulation trust, you could not use with the exception of disabled or chronically ill, by the way, that's the one limited instance where you can use an accumulation trust that does not have to be a conduit trust. And the reason for that is special needs trust will qualify as a trust that for which you could use the EDB's life expectancy. But if you have an accumulation trust, you can't use other than disabled, you can't use the EDB's life expectancy.
Okay. Thank you. Kurt, do you have any other questions?
A question came in during Nela's presentation about capacity. And the question is, when we have clients that come in our office who have adult children who are sometimes driving them to the appointment, what is the best practice about including the adult child or not including the adult child in that client meeting?
That's a tough one. They did talk a little bit about asking, especially if it's a change, if you see that they, as an example, they had their original documents drafted by Bill. And then 2 years later, they're going to Adam with a child. They talked about, getting permission to speak with the prior attorney to find out maybe what those conversations were like. Just to see if something's off, if it's a child putting some undue pressure on the parent to change something in the document in their favor. They talked about that idea of speaking to the prior attorney, but ultimately that is a tough one. And I think, you ask permission, try to ask questions to determine capacity. Maybe, as I said, recording the interview, just so that you can document that you made your best attempt to determine whether the client was able to make changes to their estate planning and they had capacity at that time.
Anyone else like to chime in on that subject? Because that is a common scenario that we all face. No comments? Okay.
This is Adam. You always want to make sure you get some alone time with the client, even if the client wants the child to be there. We're always going to insist on both before the meeting and after the meeting, getting alone time with the client up in the front end to make sure that they understand what the dangers are of having the child at the meeting, and usually making sure that they put something, that we have them sign something in writing that we've had this conversation and they understand the advantages and disadvantages of having somebody present. And then after the meeting, to give them a chance, if there was anything that happened at the meeting that they were uncomfortable with, or anything that they want to talk to us about now that the child is back in the waiting room. Again, that's ideal, and it would be a best practice. It's not always very practical, though.
Okay. Bill, I have another question that came in for Adam, and this is a big topic, so you'll have to sort through it as you see fit, Adam. But the question is, Adam, could you speak on what you heard at Heckerling having to do with gifts versus sales versus a sale to a grantor trust?
That could be a topic for another 1.5 hour presentation.
Yes.
What I was going to talk about was gift versus loans, not necessarily gifts versus sales, but there was some case law on that topic. There was a tax court memorandum case on the topic where it was determined that it was a gift and not a sale. the case, and I'm not positive on short notice that I can get you the site for it, although I'm trying to find it. Basically, the IRS has gotten into where there's basically some standard questions that they're going to want to ask in each case when looking at it, but it still is a facts and circumstances type of matter. And I apologize that I can't give you any more detailed answer off the top of my head on that from Heckerling. But I'll look to my other panelists if they remember anything.
They talked at length about the discount, which you touched on, Adam, the cracking down of using discounts when you have a fully marketable portfolio inside a family entity. That they talked about. I don't know if that was more in line with what you were going to address, Adam.
One of the areas that was mentioned was a sale. To be a genuine sale, they usually use the 10% rule. So seeding the defective grantor trust with 10% of the sale is important. Otherwise, it may be viewed as a gift and not a legitimate sale.
And private letter ruling 2020-22002. Okay, that's a transfer of assets between trusts, private letter ruling. So again, private letter ruling 2020-22002. I apologize, it's all twos and zeros.
Yeah.
All right, well, panelists, we thank you for all your insights. At this point, I'm going to turn it over to Kurt, and he's going to close our presentation for today.
Okay, well, we want to begin by thanking all of you, Nela, Bill, Adam, Jim, all the work that you did. And it is an impossible task to try to boil boil Heckerling down to a 1 hour presentation, but well done. And thank you so much for all your time and effort. We appreciate it. I'd also like to thank the Community Foundation for hosting this event and all the PAC events during the year. We appreciate all the staff does to pull that together for us. PAC members, thank you for your attendance and your referrals of clients and guests. I would just reiterate what I said at the beginning. I hope you'll kick off a relationship with the Community Foundation. When you have a client who has charitable intent, please pick up the phone, call Mark Kotler, make that introduction. Call me, call Judy Bonavac if you wish if we can help, but I suggest calling Mark, and I think your clients will be very pleased, and so will you. So for PAC members, this is the final meeting of the season, so we have the summer off. Our next meeting will be in September. That meeting will relate to private foundations and the use of the Community Foundation fund in lieu of a private foundation, some of the pros and cons there. You'll also all be invited to a Community Builder celebration on November 18th. And as a reminder, a Community Builder is a donor who commits to $1 million or more in a fund here at the Community Foundation. And lastly, I just want to reiterate my thanks to Judy Bonavac, who will be the new chair starting effective July 1. Judy, I wish we could see you on screen, but we're very thankful that you're taking on that role. And with that, panelists, any final remarks, or should we sign off? I think we're good. Okay. Thanks, everybody. Thanks, attendees. Thanks, panelists. Thank you, panelists. Have a great day. So long.